Bitcoin and energy go together like two peas in a pod? Huh.
Everybody knows that, Dad.
Well, did you know that donkeys make great crew members?
Good morning, good afternoon, good evening. I don't know when this is going to drop. Technical difficulties have us recording BDE, not going live, but welcome in, Digital Wildcatters, with my partners in crime, Mark Meyer, Kirk Coburn.
Yes, sir.
And in I guess just a statement on the quality of modern medical care in the United States. Frack Slap is missing his fourth straight episode with his prostate injury.
Well, I did go to Chat GPT, and I have some advice for Colin.
Oh, good. Lay it on us.
I said, how do you fix an ongoing prostate problem? So there's three ways, come to think of it. Medication, alpha blockers to relieve urinary symptoms caused by an enlarged prostate. So he could go get medicated. Number two, lifestyle changes. Drinking enough water, avoiding alcohol and caffeine, and doing regular physical activity. So, and then third, of course, is surgery. Ooh. Let's just stop right there.
There we go. Now we have it. I don't know what to make of this, but anyway, fine work, fine investigative journalistic work. Mark's like going, can I be cut out of this one?
Nope.
No, you're in.
Speaking of cutting out.
Da-da-da. All right, let's jump in. So BP put out their report that they do every year, as we like to say, Beyond Petroleum, or when did they come out with that? 20 years ago. Mark, what did we see in there? Anything?
Well, we saw a typical framing of the scenarios. They're not suggesting they're advocating for a certain path, and it's largely driven by IPCC net zero is the most aggressive. And then what happens to the various forms of energy, both in terms of primary and then final consumption. And in all scenarios, BP, starting with fossil fuels in the mix between now and 2050, fossil fuels are down from 80% currently, thereabouts, to anywhere from 20 to 55% of the overall energy mix in 2050. And then in terms of oil demand, which we'll talk, I think, more expansively about, there's some traffic out comparing BP and Exxon. In all scenarios, all three scenarios, there's the net zero, there's the accelerated, and then there's what they call the new momentum scenario, which is more extended, flatter transition, softer landing, if you will, for oil demand. But in each one of those scenarios, oil demand is below, if not significantly below, 80 million barrels a day. In net zero, it's down to 20 million barrels a day from 101, 102 million barrels a day currently projected for 2023.
And that's BP.
That's BP.
Now let's move forward. I know we're going to talk about Exxon, but what does Exxon say about that?
So we'll throw up the chart right now on the screen, but Exxon kind of has us running to, call it, 105 million, 110 million barrels a day, and sort of flattening off when you get into 2040, 2050.
Right. I just find it amazing that we're in this incredible time. Like, think 2 years ago, pre-COVID, during COVID, that the energy transition almost caught fire, right? Over the last 5 years, funds, billions of dollars of money has gone into private equity. We're going to talk through this later, ongoing in the show. But is oil making a comeback? And I really look at Exxon, because Exxon seems to be the ones that have the most grounded view of the world. But what do you guys say?
Well, I mean, I sit here and go, we shut down the world economy during COVID. So, I mean, an interesting experiment, right? I mean, we literally couldn't walk out of our houses, couldn't do any of this stuff. And we were still using 85 million barrels of oil a day.
In a radical shutdown.
In a radical shutdown.
In a slamming of the brakes, so to speak, to consumption and mobility.
by worldwide, you
Right.
know, and so I just don't see how we're using anything less than that. I mean, we've beat our heads against the wall on hybrid cars, and we're gonna go all in on electric cars. And we've talked on this show about how mining and the diesel needed to get all those rare earth minerals to be able to build all the electric vehicles probably makes up the slack. But I don't see how any serious person can plan for a world where we're going to use 20 million barrels a day by 2050.
Well, I'll just raise it again. This is a couple of years ago in the midst of COVID and the recovery. OPEC did update a long range forecast from 2020 to 2045, so it's not quite out to 2050. And they have net oil demand growth going up by 8 million barrels a day between 2020 and 2045. 12 million barrels of growth in non-OECD and 4 million barrels of contraction in OECD.
And this is, I mean, it's predicated on sort of the macro trends as we still see that the world population is growing from 7 billion to 9 billion. The fact that these third world countries are coming into sort of the mid-market where poor people are becoming wealthier, that drives a lot of demand for energy, and there's just not enough renewables or the capability that can replace renewable or oil and gas that quickly. Even if you wanted it to be a flash, a light switch and just turn it off, you can't do it.
I think the two long range forecasts that are being discussed today, Exxon and BP, are just emblematic of the European construct or the political landscape, and in some cases the actual rules of the game versus the U.S. based point of view. Now, I will say, in full disclosure, my formative years were spent at Exxon, so I've just got a bit of an embedded bias. But if you look at the responses to transition to energy tech, there's been a spectrum across the majors in terms of how progressive or how conservative those plans are. Exxon really middle of the fairway with big flagship spending planned for CCUS, BP going all the way into major investments today in wind and solar, and everything in between with Shell and Chevron and Total, et cetera.
And we've got these sort of two dichotomous stories playing out. One
Good
is,
word.
Thank you. One is you have
SAT prep here on BDE.
That's right. One is let me step back. My grandfather told me when I was a young boy to not go into oil and gas. So I didn't for most of my career. Now that I'm older, I'm becoming a little bit dumber. The Permian went through this sort of lull, but the Permian is booming. And I think the Permian is sort of the metric that we're going to look at for what's happening in the world, because we can't find enough people in the Permian to employ because it's on fire. And that's the big story in the Permian right now. It's like we can't even find enough people. And if you look at sort of the McDonald's, they have signs all over West Texas saying we need people. So you have that. At the same time, you see this European view. And what's interesting is Shell just announced, my good friend YL Sawan, who I used to work with and have a deep respect for, he just is reorganizing, and Shell goes through all these reorgs all the time, but he's reorganizing, putting his integrated gas division and oil into one business unit. And so it's a cash machine, and he's putting the renewables business into downstream, which is interesting because I think what he's seeing is we've got to run a business here. The independents aren't thinking renewables, they're thinking about making money, and shareholders, I think, ultimately will reward those that actually return cash to its investors, but we can argue that as well.
Well, if you look at on the U.S. side, the comparative here in the very recent past, including Exxon's report today, year to date, which is a very small sample of a month, Chevron's down 4%, thereabouts, at least last look before coming into the studio, and Exxon's up over 5%. So 900 plus basis points of outperformance coming into the year. And you look at the return on capital employed numbers that each posted December 31st for 2022, Exxon at about 25%, and then Chevron over double off of 2021 at north of 20%. So I think, we continue to see the performance of the major group driven by that very important metric in profitability and return on capital employed. And we're just at the start of the return on capital cycle after going through more than a decade of barely covering cost of capital, if not being below. And for some groups, zero.
Because the thing I've found interesting, because we might as well just kind of roll this into the mix that we're talking about. Chevron came out,
Did I do that again?
Yeah, whatever. They had relatively, one could say, disappointing type results. I mean, oil production was down 3% for the year, but they announced a $75 billion buyback, which, their market cap as of this morning was $334 billion. So what's that math? 25%.
Mm-hmm.
So that's a big freaking number to come back. But going to your point, Kirk, what I saw from these earnings releases and what you've seen dialogue-wise out there by these companies is, Chevron was talking about being at 1 million barrels a day by out of the Permian in 2025. They're not tracking to get there. Nobody can draw the line that gets them there unless they really, really get after it. And Exxon has been pushing back their forecasts in the Permian as well.
As a skeptical analyst, over the last 20 years, when have we seen the majors deliver on rosy volume outlooks long term? Back in the early 2000s, BP was all over a sustainable 5% CAGR. And it was just not, it was not aligned with really both the physical and the financial reality of being able to sustain that level of growth. Just, the enterprises are the kind of law of large numbers, if you will, just given the scale of the companies, that's a big number to sustain.
I mean, one of the issues, I'm never looking at the majors to lead in the independent, where the independents rule. Like, being able to produce in the Permian takes, you have to be nimble, takes small teams. You've got, I think where Exxon, Chevron, Shells, et cetera, BPs thrive is in these giant projects. So spend billions of capital, put in the big projects, and then, the production is huge per project. I just don't look at them as saying they're the model. And when I was inside one of these super majors, I can tell you and attest that it was such a struggle to keep up in the independents onshore, especially unconventional. We couldn't keep up because we can't move fast enough.
Well, and I mean, at the end of the day, in the Permian, your project management, if you will, to be able to grow your production really quickly is land guys out swapping stuff so that you have the wherewithal to drill long laterals.
Right.
And Exxon can't do that because they've got so many levels of. But I've got an interesting stat that ties back to the majors here, and I'll get these details wrong, but the spirit of it's right. If you look back to, call it 2012 or something, and you looked at the initial production rates of an oil well in the United States, I mean, for years it was up 30 and 40% per year, right? We were figuring out horizontal drilling.
Yeah.
We were putting the major fracs on it. And then when you looked at, I believe it was 2017 and 2018, it goes from, 30, 40% a year to like 15 and 16% for those 2 years. So you're like, well, it's slowing down. What was really interesting, though, is if you yanked out Chevron and Exxon wells in 17 and 18, or maybe this was 18 and 19, somewhere around there. If you yanked out their wells, the average well in the United States, IP rate, oil well, was down 3%. So what had actually happened, to your point, is Chevron and Exxon are late to the game of learning how to drill horizontals and fracking, but God gifted them with a lot of great acreage a long time ago. So they start drilling in the Permian late, and their gains brought up the industry to that level. But if you peeled back who was actually innovating, we'd hit a peak in, call it 2016 on performance per well. So I think to your point, majors aren't the ones that are leading the charge to hit these lofty forecasts. I don't think they have anything in their hip pocket to do it with technology wise.
Well, after watching Pioneer commit to 1 million barrels a day and then having to pull immediately back off that. I don't know why any major would even make that commitment. Just on an absolute basis, that is a huge number out of that basin, just given the well intensity and the labor intensity of the model, right? It's
If you can't find the staff, you're not going to be able to hit numbers.
right. And, battling, I think Exxon may have peaked at somewhere in the mid 50s of numbers of rigs operating in the Permian. And one very smart CFO who's now retired told me at a conference one time fairly recently that, look, there's no engineering going on at the peak of a cycle. There's nothing but engineers and geologists and technical folks doing logistics management.
Right.
And I can tell you from direct observation and somewhat direct experience, one of the companies I worked for ran 62 rigs, I believe, at the peak in the Permian. And that is an efficiency challenge and an execution challenge that I think is really, really difficult for a major to manage, just given the as Lee Raymond said, it's hard to make the elephant dance.
Thank goodness our audience has us to ferret and wade through all this bullshit to come up with the right analysis. So thank goodness.
Okay, so I'm going to be a buzzkill, and I hate to do this, but so we've basically said, we think oil demand is going to be way more than potentially even what Exxon and BP are thinking. We've said we're not going to do it out of the Permian, which has arguably been the marginal barrel for the last few years here. Now, are we going to do it with an even bigger political target on our back because Chevron's out doing this huge buyback instead of investing in the ground like President Biden demanded of them? And Exxon just reported $56 billion worth of profits, their greatest year ever.
Well, I'm going to jump into the whataboutism that
Let's do
we've
it.
recently availed ourselves of in discussing some of this. I saw a post on LinkedIn last night about a description of Chevron's buyback, or using Chevron as an example of quote unquote financial chicanery and stock price inflation, right? When the clear message from the shareholders in energy who have suffered through laggard, if not non-existent returns for a decade plus, has been, not only do we want return on, we want return of. And so we can argue the merits or demerits of Chevron's specific kind of high profile announcement. But then when we go over and look at the tech sector and the bellwether there being Apple, over the last decade, they've repurchased over $500 billion of shares. And so the point that's being made is, why not accelerate at scale the reinvestment capital to innovate is really the main point here. Why aren't you doing more in the short term to juice production? You've pointed out the logistical and just kind of structural difficulties behind that.
Why aren't you moving your manufacturing to the Midwest with all the money you've made, Apple, instead of doing buybacks, so that we're not using slave labor in effect in China?
Right.
Yeah.
But here's the thing I think Chevron's missing. If you take Apple and Exxon, who've also been big on buybacks, they did something else that Chevron has yet to do. They haven't yet to pull the trigger on $1 billion headquarters. So when you don't know what to do with cash, what do? Is you build a huge complex. And so Chevron, if you're listening, which I know most of the CEOs of the majors listen to us.
Hey, Mike.
Mike, this is a great opportunity to build $1 billion campus.
And
employer retention.
And let's go ahead and get the naming rights of a stadium or two.
Yeah, exactly. But what's interesting is, I'll tell you what's kind of scaring me is global investment in the low carbon energy transition totaled $1.1 trillion in 2022.
So we're throwing that chart up right now.
It's a new record, and a huge acceleration from the year before. At the same time, it's estimated, and this is Bloomberg, so take it with a grain of salt, a top-down estimate of global fossil fuel investments, including upstream, midstream, and downstream, and unabated fossil fuel power generation, is also estimated at $1.1 trillion in 2022. So this is the first time that global energy transition investment has matched fossil fuel investment. Now, I think if you're a pundit and if you read some of the other Bloomberg articles, they're saying like the transition's been made. It's here now. Like oil's going down. What I would argue is that we haven't invested enough in oil and gas. And that's a huge problem because we're going to see a gap out like we're seeing in food. And we can talk about that, rat hole at some point. But I'm really concerned that there hasn't been enough investment in oil and gas. What say you, and what's going to happen in the next few years if oil demand, as Exxon says, is going up?
I mean, so I had Cuppy, Harris Kupperman on the podcast last week, and we
Cuppy
talked
to you,
Cuppy to his friends and on Twitter, and we talked about potentially this super cycle coming in oil, and he's just going, he goes, the only thing I see stopping demand is if governments decide to shut us all in our house again. So theoretically that could happen. But outside of that, you see nothing happening on the demand side. And you just, by any metric, we're underinvesting, whether it's new builds of oil field equipment, whether it's dollars in the ground. I mean, when's the last time we spent an exploration dollar? Like a true old school wildcat well.
We're going to be, we can't put this on YouTube now that you said that.
Yeah.
We used to, we used to be pretty good at exploration, except for the coincident 2 decades or so that unconventional has been around. And we would track conventional exploration globally, the good old fashioned actually finding it. And some of it was a classification issue, but there were success rates for a long period of time over the last 20 years that were running in the 15%. And they were finding, in my expression, the wrong stuff because they were finding a lot of gas.
Yeah.
Right. I actually think the success rate is lower. And so if you look at
the geologic success.
Right, exactly.
Yeah.
The dreaded geologic success. If you have to do a restart to try to backfill some of this maybe, I don't want to call it plateauing, but decelerating rate of growth coming out of the reliable Permian, do you then have to toggle
rate of investments?
Right. Do you then have to toggle back? I think this is, a long running theme as well. Do you then have to toggle back to restarting or accelerating the capability in conventional exploration, a lot of which is going to be offshore and deep water and international as well?
Well, and let's take it a step further too, because we've underinvested, and the war in Ukraine points out again that when you buy oil or energy from dictators, bad shit happens, right? And so we still get a lot of our energy from bad places in this world. So, we're underinvesting, and let's say a bomb goes off in the Gore field.
You've been promoting your.
I'm not promoting this. I'm just saying that is a real scenario.
First year, that is your big, prognostication for this year, is that something big like this will happen. So I love you promoting it.
It could.
We don't want it to happen, but it could happen.
We have been totally spoiled, and I will pull up this data and we will get it on the air in the next 2 or 3 weeks. But if you look at political turmoil shutting in oil over the last 30 years, we have been on an amazing streak vis-a-vis the 60s and 70s, where wars and stuff were shutting in oil on a fairly regular basis. Now, maybe that's just the new globalized world and everybody plays nice and oil comes out, or maybe we've been damn lucky. And so that's my worry, is that we've been damn lucky.
One of the interesting highlights that have been sort of gnawing on, is interestingly enough, is that the U.S. is on course to double its liquefaction capabilities and exporting LNG. And we are currently the world leader of exporting, and Qatar's number 2. But by 2027, it's estimated that we'll go from 78 to 169 million metric tons of liquefaction capacity over the next 5 years, which will far outpace anyone else. So my point is, as I'm thinking through this, wars on the sides, which I think that is a huge risk, is that while we're underinvesting, we are definitely building the capacity to export our oil, our gas to the rest of the world, which could be a really good for the United States.
Good for the world.
Yeah. Natural gas is the strategic weapon, both offensive and defensive.
Good for the universe.
We rank the U.S., I believe, not North America, the U.S. ranks currently 5th in the world in total proved natural gas reserves. We have the potential, and I think we're a quarter to a third of Russia. We have the potential, in my view, long range, particularly if you bring North America into the mix, particularly the U.S. and Canada, to far outstrip that and then start to push out coal as a power generation fuel. But you got to do that in a fairly timely way, fairly rapidly. And, who's going to provide all that capital, particularly when we see I'm enjoying the back and forth on what's going on in the natural gas realm, particularly E&Ps lately here with the collapse in natural gas prices. Where's the staying power and the returns incentive to make that happen? Potential's there. The know-how's there. We're going to add some meaningful capacity, and we ought to continue to build on that. I just don't know how we do it.
I would actually have a lot more respect for the World Economic Forum if they sat there. They can all still fly there in their private planes. They can do that. But if they sat there and said, okay, here's the Marshall Plan for energy transition, the U.S., Europe, we're going to finance to China and India natural gas infrastructure. I mean, I don't know that China would let that happen. India might. India is kind of like, whatever, guys. China kind of views us as a mortal enemy, so they may not let it happen. But if we did that, I mean, we could certainly supply it if we had the political will to do it, and that would be the most effective thing we could do to reduce CO2 emissions.
Yeah.
Well, what's interesting about China is China, of that 1.1 trillion for energy transition investment, half of that went to China, which is funny because China's just turning around and selling. They're just making money.
Yeah, they're building it all with coal.
Yeah,
right?
yeah, they're building it with coal, but they're taking all the investment and turning around and selling it to the rest of the world. Like they're winning.
They're exporting coal.
Their strategy is a huge winner. So I don't know what China is a dictatorship in a big way, but man, they sure figured out how to take advantage.
So going back to the 1.1 or 2 trillion of alternative or renewable investments rivaling traditional energy, how much of that is related to the push by the majors or traditional energy in general? How much of that 1.1 trillion is the investment of traditional energy that has been, the headline focus? They need to do more. BP's, made big commitments.
I don't think it's actually as much as you think it is, because
it'd be interesting to see like that versus like Google and Apple.
Yeah, I don't think it's a lot,
It's
nor
not a
should
lot.
it be when you look at the relative proportions of the size of traditional energy versus everyone else, particularly tech. Why do we care? And this point's been made before. Why do we care what the majors are doing outside of its convenient political focus, what the majors are doing in transition to renewables and innovation in that regard? If the return performance from their traditional business over the last 10 to 20 years has been marginal to poor, right? What, as Mike Worth said a year and a half ago at their new analyst day, when they rolled out Chevron New Energies, and they made a very explicit point.
He just texted me, calm the F down. So
one of the paths or two of the paths that they were not going to pursue because they didn't have an advantage and they didn't see the return opportunity was in wind and solar.
I'll tell you
which was somehow controversial.
There's only two groups that care, or three groups: institutional investors, shareholders, and competitors. So the majors, having been inside of major and have never destroyed capital because my investments actually are making money. But the argument is there's this huge push by institutional investors for them to get rid of oil and gas as an asset class. And now I think that's going to change. But the pressure on the management teams of these majors is, look, we don't need you to transition because we can put our money into a Tesla, not you. But what the majors are doing is they're getting pressure from both sides. They're getting pressure from those that only want them to just return dividends, and they're getting pressure from, the banks, the Church of England and others that are saying you need to transition your entire business over to renewable. So they have a window of funds that they can use to say that, hey, we're doing good stuff. But the problem is, and this is the biggest not secret in the room, is that the returns aren't there on renewables. And it's funny because when Shell and the executive is no longer with Shell, when he said we're going to be the largest, utility in the world by 2025, he got in big trouble for saying it because one is the fact is where are we going to make the money? But some of my friends that are running some of the most profitable renewable businesses that have been from a utility laughs at us because they're crushing it because they know the business. I don't think these majors understand this business, and the returns aren't there.
Well, and the investment that is being suggested doesn't come with a commensurate return that shows up as accretive to return on capital employed, which is, part of the reticence. I think the part of the majors are now getting back to kind of salad days returns on capital employed. The notion that you can even attach this to really shifting hard back into long cycle. When are you going to start to see returns from very long cycle investments like those big projects in deep water?
Well,
same with the more ambiguous renewables that have not certainly in some cases reached commerciality at scale.
There's a reason why the new CEO of Shell came from deep water and integrated gas, because the future is making money, not running around saying, hey, we're going to make money on renewables. That might be a path, but right now, financially, there's no logic at this point.
So, agree with both y'all. Now let's go triple interest rates and see how great that shit works. Because that's all right. I got a fact here that may only interest me, but we'll spend a quick minute on it.
It's your show, Chucky.
2022, first year in the U.S. E&P M&A market where we didn't have a $10 billion deal, a deal greater than $10 billion since 2013. But on the other hand, we had 25 deals between $1 billion and $5 billion, and that was the most since 2016. Just a tidbit that kind of interests me. Now, one other quick thing before we get to Finger of the Week.
Well, do you have any other opine on that, or just you just want to say the
Facts
stat?
that may only interest me.
It is interesting.
I
like
kind of
it.
interesting. Okay, we got to spend 45 seconds because we had to retire giving Finger of the Week to Biden just because of all of his shit. But dude's in a $150,000 electric Hummer talking about, don't worry, guys, I'll give you $7,500 to go buy one of these. Seriously?
I think he said in his tweet, the Great American Road Trip is now electric or something like that. And he's in the photo op in the electric H2.
So if Zero is like the Pope or Gandhi feeding the poor, or Mother Teresa
let's use Mother Teresa.
Mother Teresa feeding the poor, and 10 is Marie Antoinette saying, let them eat cake. Where is it on a scale of 1 to 10?
I mean, 11. Can we say that?
Oh, you got it.
Before we get to Finger of the Week,
Okay.
let me tell you something that's interesting. Is we've talked about Chat GPT and how it can do everything. It's the AI of all AIs. So I just said, hey, I can tell you what the natural gas price is, but I was like, hey, Chat, what is today's natural gas price in the U.S. and Europe? This is Chat GPT, the most powerful AI in the world that's changing all of our lives. I'm sorry, I do not have the current natural gas price as my training data only goes up until 2021, and I cannot access real-time data. Natural gas prices can fluctuate on a daily basis. I mean, this is technology. They do not like us. They're against us, but we're going to fight back and we're going to prevail. Just saying.
There we go. All right, everybody, the Finger of the Week. All right, this week's Finger of the Week, in case you didn't recognize the picture, the Empire State Building. I mean, the bastion of New York. All that is New York starts with the Empire State Building.
Number one.
Lit itself up as green this week. in honor of the Philadelphia Eagles, the NFC East rival to the New York Giants, making it to the Super Bowl. King Kong is right, man. The Empire State Building is just fucked up. That's horrible.
I mean,
That was my finger
It's like
of
the
week.
tower going purple, or our conference alignment once the playoffs roll around and we're on the outside looking in, right? So we're gonna have a championship or success by association.
I'm just rooting against the Eagles. I mean, as an Astros fan, Philadelphia's going down. The fact that New York's trying to prop them up just tells me everything you need to know.
I think so.
You can't do it on home state of the starting quarterbacks because they're both from Texas.
Yes, sir.
That's true. That's true.
Now,
And,
if we could pick cities, right?
and
Go Mahomes.
another fact that only interests me is I believe Coach Kingsbury at Texas Tech, having Pat Mahomes as his quarterback, only had one winning season, which is beyond me how that happened. And two, in a bit of good news, this is the first Super Bowl we've had where both starting quarterbacks have been black. That's cool. Because I remember growing up. Y'all remember growing up what a big deal Doug Williams was, And so anyway, cool to see.
There you have it.
All right, Digital Wildcatters. Thanks everybody for joining us this week. We'll figure out our technical shit and get all this together. But if you like the podcast,
It's the outside pipe.
Yeah, exactly. It's the outside pipe. And there you have it. Take
Cheers,
care.
guys.